The two best stocks to buy in November of 2025. This is a video that I do every single month talking about my two best ideas. The last one was really good. I talked about Amazon. It was at 220, now it's sitting around 245. I also mentioned SoFi when it was trading at 25, and now the stock is at 31. It's up like 35% in 1 month. So that was very timely. I'm not sure if this one is going to be as timely as the previous one, but I'm going to share my two best ideas for November. They're very different from each other. I think you will enjoy it very much. If you do, all I'm asking, please press the like button and let me know what you think in the comments. Now, the best stock to buy in November, in my opinion, by far, amongst quality companies, mega caps, the big seven in general, is really Meta. Meta is down 11% over the last months. Meta right now is trading at 21 times forward earnings. 21 times is really cheap for the company, considering the market in general. This market is very expensive. And if you compare Meta to the big seven, it's the cheapest by far. Meta is trading at 21 times forward earnings. Then you have Google trading at 27 times, although Meta is growing faster than Google in revenues. Then you have Microsoft at 30 times forward earnings. Then you have Apple with no growth at 33 times forward earnings. Then you have Nvidia and Amazon at 33 and 34 times earnings. But Meta, 21 times for this company is dirt cheap. Meta has access to 3.5 billion daily active people, 3.5 billion people every single day. They can launch threads, they can launch any new app that they come up with, and they can advertise it to not millions, to billions of people for pretty much for free. I mean, how valuable is such a network? And I don't believe it's only worth 21 times forward earnings. Revenue growth has been reaccelerating from 16%, 21%, 26%. Not in earnings per share. This is just the top line, guys. The bottom line, if Meta wanted to, it would pretty much be double the revenue growth, around 40 or 50% earnings per share. And I'm going to talk about that a little bit more later in the video. But they have also very high net profit margins. They've been improving from 19%, 29%, now it's 38%. 21 times earnings is just cheap. The business is doing really well. Their family average revenue per person has been also increasing to $14.46. Now, if the core business is so amazing and everything I showed you, then why is Meta going down? Well, it's mainly because of CapEx. The company is ramping CapEx again. They borrowed like 25 billion because they want to do even more CapEx. And the market is worried that this is going to be Meta's metaverse moment, like what they had in 2023. They're doing it again, and they're just wasting the money. Now, Zuckerberg, I believe he learned his lesson, and he's playing it in a different way right now. Back in 2022, 2023, he was going all in on the metaverse. This is not what he's doing right now. His bet right now is if he wins, he's going to win big. But if he doesn't win, or if it takes more time, then he still somewhat wins, or he doesn't really lose too much. So it's nowhere close to throwing your money in the toilet like the metaverse kind of bet back in 2023. And this is what he himself said on the latest earnings call. He said, we're also building what we expect to be an industry-leading amount of compute. Now, there's a large range of timelines for when people think that we're going to get super intelligence. Some people think that we'll get there in a few years, others 5 to 7 years. I think that the right strategy is to aggressively front load building capacity, so that way we're prepared for the most optimistic cases. Now, if it takes longer, then we'll use the extra compute to accelerate our core business, which continues to be able to profitably use much more compute than we've able to throw at it. And in the worst case scenario, we were just slow building new infrastructure for some period while we grow into what we built. Our AI recommendation system are delivering higher quality and more relevant content, which led to 5% more spent on Facebook in Q3 and 10% more on Threads. So the way Zuckerberg is playing it is he's trying to front run super intelligence, and he's spending a lot of money right now. Now, if it takes longer than expected, longer than 5 or 7 years, or maybe even 5 or 7 years, then he can slow it down, or he could use the compute for their core business. So this is not something that they don't need. Worst case, they just use it for the core business over time. So they're not really losing in it, but he's front loading it, and he's investing a lot of money at once. Now here comes 2027, they're not going to be investing as much because they invested all of it in 2025, 2026. Then the stock goes up. I mean, this is how narrowed the market is. To me, it's really crazy. And the core business is fine. CapEx is something that they can really pull back on anytime. They could decide tomorrow to pull back on CapEx, and people are still going to use WhatsApp, they're still going to use Instagram, they're still going to use Threads, they're still going to use Facebook. So to me, the whole sell-off is really, really funny. But if you look at Meta's income statement, which is what I wanted to talk about in terms of earnings per share growth in general. The company is making 155 billion in gross profits. Out of the 155 billion, they're spending 52 billion dollars on research and development. Now, Meta already has WhatsApp, they already have Instagram, they already have Facebook, they have a lot of things. Do you think Meta really needs 52 billion? I don't think so. They're mainly investing it for growth, and they also invested to reduce net income so they don't have to pay as much in taxes. This is a trick that a lot of the big seven use. Now, if Meta decided to spend half of that, maybe not 52 billion, maybe 25 billion tomorrow, okay? If they decide to do that, Meta would still be fine, WhatsApp would still be here, Meta would still be growing, but net income would jump by about 50% from 50 billion to like $75 billion. And the PE that we're looking at is not at 21. It would be like 16 or 15 or 17. So this is how much more profitable Meta could be if they wanted to. But they're choosing not to be profitable on purpose, to save on taxes, and to also invest in the business for the long term. Same thing in their CapEx, where they're making 107 billion in cash from operation. They're spending 62 billion on CapEx. Most of it is gross CapEx. And this is something that the company can pull back anytime. So anytime you have a sell-off due to a one-time event that could be changed at any time, and the core business is fine and is growing and is doing well, and you're paying a low multiple for that, it generally presents a really good buying opportunity. And for the business model of Meta, for the 3.5 billion users, and everything I'm getting, WhatsApp and Facebook and Instagram, and a founder CEO, 21 times forward earnings is really cheap, especially in this market. So it's hard for me not to say that Meta is by far the best deal in the market, especially amongst the big cap stocks and the Magnificent Seven. Now I'm going to talk about the second one, which is a stock that I talked about many times, and you guys have asked me for an update. And this is a stock, again, if you're looking to be outside of the big tech, outside of hype and AI in general, you're looking for something that's uncorrelated, that could be potentially a good investment. This company is called Cheniere Energy. Cheniere Energy is down 12% over the last months. I never really believed the stock would go back to 205, but it actually did. Now, Cheniere Energy has the largest liquefaction facility in the United States. They have the second largest one in the world. They liquefy the gas and they ship it all over the world to Europe, Asia, Latin America. And this company, amongst other companies, they're benefiting a lot from the trade war that we had, because a lot of those trade deals include commitments from a lot of nations to buy US LNG, which has to be shipped from facilities like Cheniere Energy. Now, whenever I'm talking about gas and natural gas, you maybe look at the chart of gas and you see a lot of volatility, and you might be scared. You're like, I don't want to touch that. That's too volatile. It's too speculative. But Cheniere Energy is very different from a traditional natural gas stock. And this is one of the recent contracts that they signed. They signed a contract with another party to purchase 1 million ton per annum, and it's going to start from 2029 to 2050. They're selling capacity. They don't even have it yet. They're already building those facilities. They're not going to be completed before 2027, 2028. They're already selling 2029 from now, and to contracts going up to 2050. The company has 35 years average contract terms, and they have very long-term contracts with third parties where most of their tons of gas is sold pretty much for the next 20, 30 years. So it's more of an infrastructure bet, because they don't only get a fixed price based on Henry Hub, but they also get a liquefaction fee for liquefying the gas. So this is more, again, of an infrastructure bet than just a bet on the prices of natural gas. It's nothing even close. So it's a very good business model. In terms of the latest quarter, it was pretty amazing, and the company raised their distributable cash flow, which is what you should be looking at if you're looking to invest in the company. Now, the question is, if all those things are amazing and the company is doing so well, then why is the stock going down? Well, there's two reasons. One of them is there's a massive rotation outside of non-AI stocks. That's why Waste Management is going down, Cheniere Energy, Berkshire Hathaway, any kind of stock, railroad stocks, any stock that's not too exciting with AI is going down a lot. But eventually the AI rally is going to end or is going to cool off. And those kind of stocks will eventually catch a bid again. So a lot of the decline is not due to the company underperforming. It's due to money flows and rotations within the market. But the second reason, which is the biggest concern, is there's massive, you could say, ramp up in natural gas capacity coming from the United States. And we're going to start to feel the effects of that as soon as 2026 and 2027. This is a recent article that says global LNG capacity is set to increase by a staggering 60% by the end of the decade. Demand growth is unlikely to match the pace of 60%, while supply and demand is largely imbalanced this year. The market is expected to tip into an oversupply in 2026 and a much more oversupply by 2030. So the United States is drilling so much gas, here you could see it in the yellow, that the capacity of the United States, the exports, is expected to more than triple or quadruple. So they're going to flood the market with natural gas. And the concern is that, one, natural gas prices could potentially decline, which is not good for a company like Cheniere Energy. And the second one is many different competitors are building liquefaction facilities, and they would put some margin pressure on Cheniere Energy because there would be much more competition as a lot of them are getting permits to build a lot of those facilities. Well, there's two things around it. The first one is the company has, again, 35 years worth of contracts. So a lot of those suppliers, they've been dealing with Cheniere for decades. They're going to continue to deal with Cheniere for decades. So the last thing I'm worried about is other competitors taking market share from Cheniere, as Cheniere has those relationships and they're built over 20, 30, 35-year contracts. But the second one is their guidance is based on a much lower natural gas price. So the guidance that I'm about to show you is based on 2.5 on Henry Hub. Now we're trading at 4.2. And as you can see, natural gas barely goes to 2.5 or below. If it goes below 2.5, it doesn't stay there for too long and it bounces. So if we do have an oversupply, maybe natural gas would trade at 2.5. But this is what the company's guidance is based on. So all the numbers that I'm calculating are based on 2.5. And if there's upside from that, then we get the upside also. So that's how I'm looking at it. Now, for their own guidance, they're guiding $25 of DE or distributable earnings per share by 2030. The company is buying back a lot of stock. They want to buy back more stock. They're increasing their dividends and they're expanding their facilities, and they want to reach 25 of DE by 2030, and they have a good track record of beating that and over-delivering. And I said it could be up to $27 of DE or distributable cash flow per share. Now I'm going to make two calculations. The stock right now is trading at 16 times. I personally believe 16 times for such a predictable business model is cheap. I think Cheniere should trade around 20 times. That's where the stock was trading at, and it's been trading there pretty much on average since late 2024. So I think 16 is cheap, but I'm going to use 16 and I'm going to use 20. Okay, and the stock right now, I believe, is trading at $205 per share. So I'm going to take their own estimate of $25 of distributable earnings per share, and I'm going to time it by 16 times cash flow. This is around $400 per share. The stock right now is around $205. So this is almost 100% on the upside over the next 5 years. Not bad at all with an uncorrelated bet like Cheniere Energy. Now let's say it trades at 20 times cash flow, which I believe is highly likely, and we time it by 20 times. This is $500 per share, and the current price is around $200 and $205 per share, which would be around 143% on the upside over the next 5 years. And this is excluding if the company was able to exceed it, and it excludes many different things. So to me, Cheniere Energy, I think the sell-off is overblown. I think it's potentially presenting an opportunity here, and I'm liking it very much. But there's also other stocks I'm watching, like one of them is EQT. EQT, they have pipelines in the United States, so it's not as dependent on exports as Cheniere. This is more like domestically, and those pipelines, they have a moat where you're not going to go and build another pipeline. But EQT is expensive, and I'm waiting for a lower price. But I think Cheniere looks really good over here. The sell-off is definitely overdone, and I still like it very much. So that was my stocks for today, was Cheniere Energy and Meta. Hope you enjoyed it. Not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.